Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about recession. Okay, we're hearing a lot of noise out there in the news about a recession, and we just want to make sure that our listeners understand what is a recession and how it affects your investments. And unfortunately, a lot of people look at a recession and they think of depression. I mean, they are two completely different things. So we're going to look at, the basics of what a recession really is. We're going to look at and talk about what we saw as an indicator in the news here most recently. There was breaking news that there was an inverted yield curve and why that is an indicator of an upcoming recession. And then we'll look at, what should you do with your investments during pre-recession or recessionary times. So Tyler, as far as a recession is concerned, I mean, it's really nothing more than a slowdown in the economy for 2 or more quarters as based on gross domestic product. So if we see, wholesale, retail sales slowing, employment, real income, industrial production, and so on, I mean, that's really what a recession is. And the recession really starts just after the economy reaches its peak of activity and ends after it reaches its trough. So that is a normal process in the economy. It's called the business cycle. And what you have are ebbs and flows of the business cycle. When you're at its peak, like we have been here in the United States, the economy is booming. You're at your peak. And after you start coming off that peak, you start going into a downslide, which is really recessionary. And then eventually the recessionary slide starts to come to a halt, and that is the bottom, which is a trough. And then from the trough, you start going up again into growth until you hit a peak again. And that's how the economy works. And are there certain times that make you feel better as an investor? Sure, there are. Everybody would like to stay at the peak forever. It doesn't happen. And also remember that a recession isn't necessarily 100% bad for investors in the economy. It resets the economy. It gives the economy an opportunity for growth again, because as a recession goes down and finally bottoms out and starts coming back up, you start that business cycle on a positive side all over again. So we want to make sure that people understand, what a recession is. Also, we're going to talk about, how have past recessions affected your investments. And we're going to look at that a little bit. I think it's going to surprise some people that you see some significant growth during that time period. So that's just a basic as to what a recession is. However, what we've been hearing in the news has been an indicator of recession, and it's called the inverted yield curve. And Tyler's going to explain to you what that is and why it's an indicator of recession.
Yeah, Dean. So like you said, when we talk about a recession, it's generally considered a slowdown of economic activity as measured by GDP or gross domestic product lasting 2 consecutive quarters or longer. And that's where trade and industrial activity are reduced and they're slowed down. People think about a recession, and recently we've been seeing a sell-off in the stock market because when people think about that, they have bad thoughts, just because the recent recession that many people think about is going back to 2008, and that was known as the Great Recession. That was the one that was the most long and drug out. And typically recessions don't last for much more than a year, but that one was a year and a half. So that's why when people think about a recession, they're a little leery, just because the last one that we had was the longest lasting one. But typically they're not that long, and they're normal to happen over time, over different business cycles. But what happened recently is An inverted yield curve is what it's called, and it's important to know regarding a recession because what happens is the 10-year Treasury yield falls below the 2-year yield. So what that means is whenever a yield falls, people are buying more of those bonds. So treasuries are different types of bonds, and they're used for stability and protection. And if the 10-year falls below the 2-year, that means many or more people are buying longer-term bonds because they don't feel confident about the near term of the economy, of the short term. So what they're doing is they're buying long-term bonds. That's why they buy into the 10-year, and that puts that yield below the 2-year. Now, why this is important is because an inversion of the yield curve, the 2-year to the 10-year, has preceded every recession in modern history. So every single time this had happened, it was followed by a recession. However, that recession, it doesn't always happen right away. Typically, it'll happen anywhere from a year to even 2 or 3 years after that. So people get a little bit leery, they get on edge right now, but it's important to note that it's not like a recession could happen tomorrow. It could happen another 2 years from now. So that's something important to keep in mind. The last yield curve inversion was back in 2005. And after that had happened, stocks rose for 12 straight months before getting a little bit volatile in 2006, and then obviously that led to 2007 into 2008. But for a whole year after this had happened back in 2005, stocks were positive for 12 straight months. So that's something important to keep in mind.
Okay, Tyler, you bring up a really good point. First of all, you talked about the Great Recession of 2007, 2008 being the longest. First of all, that's an aberration. As Tyler said, it was the longest. It's also the freshest in our mind. We tend to believe that the name of the Great Recession is a poor name for what happened in 2007, 2008. I would look at it more as a market collapse. And part of the reason is a recession was only one part of what happened during that time period. If you look at 2007, 2008, we had a mortgage industry collapse due to subprime mortgages. So you had a major driver of the economy collapse. If you remember, the housing industry collapsed, people were foreclosing all over the place. That was not good at all. That is not necessarily recessionary. Recession can trigger some of these, but that was a collapse in part of our market, a major part of our driving market. Second thing is we had a financial markets collapse. We had Citibank and Goldman Sachs and Lehman Brothers either received government handouts to keep them alive and keep people employed, or they went out of business. Lehman Brothers was a major player as an investment firm back at that time, and they're no longer around. Part of it is a financial markets collapse. And then you had a program called TARP, T-A-R-P. It was a government bailout program. So here are three major things happening. In the government bailout program, if you remember, the government kept GM alive. It kept AIG alive. So that was, I'm 58 years old, and I don't remember that ever happening prior in my life here, my adult life. So that was a major collapse on top of recession. And as Tyler said, going into the Great Recession, the stock markets were doing very well. Coming out of that Great Recession, the stock markets have been on a 10-year bull market, one of the longest in the history of the United States. So do understand when people start talking about a recession, it's not just flight to safety. Sell everything, put it in cash, put it in bonds. Quite honestly, we're very leery about the bond positions that a lot of people think they should carry in their portfolios. It needs to be scrutinized. Are you looking at short-term bonds or long-term bonds? Are you looking at for protection, or are you looking at picking up income? So those are the things that you need to discuss with your advisor. And lastly, when it comes to the recession here, if your advisor is not talking the economy with you when you come in for a review, get a new advisor, because our market is driven so substantially right now in 2019, 18, and it will be next year in 2020, based on both politics and the economy. Tyler, did I miss anything there with the 2007, 2008 summary?
No, Dean, good points there. But the last thing when it comes to the inverted yield curve that I just wanted to touch on is ultimately the reason why is because more people are selling off stocks, and when you sell off stocks, that leads to the stock market going down, and they're taking the money that they had in stocks and then going into bonds, which again, bonds are used for more stability. So that's what really alerted the market, and it was a recessionary sign because many people were selling off their stocks, buying into bonds in preparation for what might come in another 6 months, 12 months, year and a half, 2 years. You don't know the time period, but it's a sign of what people are thinking is going to happen in the future, which very well likely could happen. But again, it's not always, the stock market doesn't always follow along with a true economic recession.
Okay, good points, Tyler. Also, I want to throw in there too that we're looking at indicators that say a potential recession is coming up. Well, first of all, how do you know that? You have to look at some basic indicators. But if you look at some of the last recessions, they were not called a recession until after the event was over. There is a group of economists at the National Bureau of Economic Research. They are the ones that usually determine whether a recession has been hit or not. So you look at the Great Recession of 2007. It wasn't, or not the Great Recession of 2007, 2008. It really wasn't determined that it was completely a recession until after 2008. You look at a recession back in 2001. Wasn't determined and called a recession until November of the next year. You look at a recession of 1990, it wasn't called a recession until April of the following year. The recession of 1981 wasn't recognized until 82. So many times it's back thinking. You have to look back at it. So that just goes to show you that some of these recessions are not that monumental at all. And as Tyler said earlier, we typically hit a recession every 4 to 10 years. So many times you go through a recession, you don't even know it. And again, a recession doesn't always mean that the stock market is going to collapse. As an example, this bureau, this group that we were talking about, the National Bureau of Economic Research, they looked at the last 9 recessions starting from 1957 right up through the 2007-2008 Great Recession. And if you look at it, there were 5 of those periods of the 9 recessions that they look at. 5 of them were down during the year of recession as far as the stock market is concerned. 4 of them were actually up. The year prior, you only had 2 of those great recessions down. They were the stock market was up, and some of them substantially. The year after the recession, the market was up in 8 of the 9. The only one that was down was actually 2001, the dot-com bubble burst. So you really need to look at these things and say, okay, am I making a knee-jerk reaction wanting to bail out of the market? Well, we always believe in building up cash in your portfolio. Part of the reason is it gives you a wonderful opportunity to buy your way out of a certain portion of the market trough. It also gives you a great opportunity to be able to buy when things are on sale. Again, look at the the recession of 2007, 2008. That's where Warren Buffett really made hay. I mean, he went out there and bought Goldman Sachs, he bought Citibank, he bought things that were of value at that particular time. Now, of course, Warren Buffett can do that because he has, billions and billions of dollars to buy at that time. But do understand it does give opportunity. Doesn't mean the market is always going to go down.
Yeah, good points, Sir Dean. And many times people are surprised to realize, like you had mentioned, that whenever there's an economic recession, doesn't always mean the market will follow that. And there's actually times where the year before a recession, the year of a recession, and the year after a recession, the market can be all positive in those years. And we saw that going back to the early 1980s when that happened. The market was actually positive for all the time that we had a recession. So that's why, like you had mentioned, doesn't really make sense to make a knee-jerk reaction just based off of news that there could potentially be a recession. Again, the underlying economy still looks very good right now and very strong. Just that in the future it could happen. And again, even if it does happen, there are times in the market where the market was still positive and by a good amount in the year of a recession. So no need to make a knee-jerk reaction if that were to happen. But what we want to get into next is we want to talk about how to prepare yourself for the next recession if it should happen within the near future. So first, the number one thing would be build your emergency fund. And this is something that not everyone, actually many people don't have this. But the reason why you want to build your emergency fund, and what we recommend, is usually anywhere from 3 to 6 months worth of living expenses in your savings. So if you feel more comfortable with 3, that's fine. Some people feel more comfortable with closer to 12 actually. So it's really whatever you feel comfortable with. But we recommend at the very least 3 months of living expenses in savings. So, if you find that you spend about $4,000 per month, then about $12,000 you should have set aside as an emergency fund that you don't touch unless something were to happen. And the big reason why you want to build your emergency fund in times of a recession is because if you do need money, if you need to take a withdrawal for whatever it might be, if your car breaks down, if you need a new roof, a new appliance around the house, whatever it might be that pops up to be an emergency, the last thing that you want to do is go into a retirement or an investment account during a recession if the market is down and pull from your investments that might be down. You always want to buy low and sell high. You don't want to sell when the market's going down.
Good point. And Tyler, I just wanted to interject here that a lot of these things that we're going to be talking about, we're doing right now with our clients, okay? And these are some of the things that you should do as a pre-retiree anyhow. But, for instance, Tyler's talking about build up your emergency fund. Adding to that, you also don't want to take on debt during a recession. So if we really see an indicator that recession could be on the horizon, and as Tyler said, the inverted yield curve usually gives somebody a year, 2 years, maybe even 3 years before recessionary factors really come into play. If that's the case, if your business is booming right now and you feel like your business has peaked, do you really want to take on substantial debt that you're going to be paying over the next 10 or 15 years? So for instance, if you're leasing a building right now, your business is booming, but you think we could be going into recession, do you rethink that and say, I'll just commit myself to the lease again as opposed to spending a couple $100,000 and buying a warehouse? So those are some of the things you need to look at. You don't want to take on debt during that recession.
Yeah, Dean, one more thing that I just wanted to mention is the reason why it's important too to not have to pull from your investments during a time of a recession is going back to the most recent one, which again was the worst one back in from 2007 to 2009, the Great Recession of 2008. And reason being is that if you didn't have any type of cash built up there, then the overall stock market from peak to trough was down 52%. And if you weren't allocated properly, or if you didn't have cash built up, then you were pulling from your investments when they were down over 50%, which can really magnify the losses that you have within your account. And there were people who might have retired in mid to late 2007, and by early 2009 they were looking for a job again because they weren't managing their investments properly. They were taking withdrawals when the market was going down, and they didn't have anything built up in cash or bonds. So it's really important to allocate properly and make sure that you do have cash built up within your portfolios and even an emergency fund outside of your retirement accounts. That way you can pull from there in emergencies as opposed to trying to take and sell off your investments at a low point when they're going down.
Okay, good points, Tyler. Before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we were talking about, not taking on debt as we're going into recession or during recession, but what about paying off debt? Absolutely. So if you have debt right now and our economy is starting to show, signals that we could become recessionary here in a couple of years, you want to use to the best of your ability everything you possibly can to pay off your debt. Going into a recession, which could be prolonged, typically aren't, but if it's prolonged, the last thing you want to do is find out that your business could be hurting. You might be laid off as a result, and you have significant debt. So use this as an opportunity when things are going quite well to pay off as much debt as you possibly can, especially if you're looking to retire during what could be recessionary times. You want to try to get that mortgage paid off. If indeed you cannot pay off that mortgage, start paying off the credit cards, start paying off the cars, any other debt that you might have. If you are a property owner, for instance, you're buying investment properties, many times people will leverage one property against the other, and they'll have 5, 6, 7 different rental properties, and every one of them has a mortgage. Well, start taking some of the proceeds, some of the money that you're getting as rent, and pay off more aggressively. Start reducing, your 5, 6, 7 different mortgages down to 2, 3, and 4 different mortgages. So we want to see you pay off debt also.
Yeah, good point there, Dean. And that's really an important one where you want to do that, especially when the economy is doing well, like it has been right now and for the last few years. You want to do it right now because there's been times where people, they try and pay on a mortgage when the market's going well, and they plan on continuing to keep a mortgage over the long term. But what happens is during a recession, there's a slowdown in industrial activity, trade activity, and there could be more job loss. So the last thing you want to do is, go through a job change and still have that mortgage out there that you have to pay on, and then you're in between jobs. Just not a good situation that way. So what you want to do is you want to try and pay down debt, obviously outside of your mortgage, but then your mortgage as well, which is many people's largest debt. Pay that off when the market's doing well, when the economy's doing well, so that way if there is a recession, come that time, you don't have to worry about a potential job change or a reduce in income having to pay that mortgage down. So pay off debt, that's one thing that you can do to prepare for a recession.
Okay, the next thing we're going to talk about is, Tyler brought it up a little bit earlier, and that is those people during 2007, 2008 who had retired during that time, unfortunately, because their investments went down so much, they had to go back to work. Well, let's look at those people who right now are planning on retiring. Again, if we think that we're going into recession and you worry that much that a recession could be pretty dramatic, we do not see those indicators. But if you do, you might want to stay working a little bit longer. Okay, you might want to be working yet in retirement. It might be a part-time job so you don't draw down so much on your investments. Let's say we do go into a recession where investments do drop. If you're taking systematic withdrawals, which means they come out every month and go into your checking account, if you're taking those investments when the market is down, you're going to deplete them quicker. You're going to use more shares at a cheaper price because you still need that $500 or $600 every month, regardless of what the market looks like. So if you pick up a part-time job to soften the amount that you have to withdraw from your accounts, it's going to help you dramatically. So we're not saying don't retire specifically just because you feel there might be a recession. Remember, a lot of the recessions from the experts out there have been determined after the fact. You've lived through certain recessions that you didn't even know of. So again, might want to look at picking up a part-time job if that's the case.
Yeah, good point there, Dean. And oftentimes there's something that it's called sequence of returns risk. And what that is, like I had mentioned earlier, where if you retire during a down market and there might be 1, 2, 3 straight years where the market is down, if there's a prolonged recession or prolonged economic collapse, like there was back in 2007 to 2009, what happens is if your investments aren't allocated properly and you're taking money out of them, you can really deplete your retirement funds a lot quicker than you would hope to if we have a down market early in retirement. Whereas if you have an up market heading into retirement, the chances of that happening are a lot less likely. So make sure that your investments are allocated properly and potentially look at getting a part-time job, because that'll only help, because the less strain that you have to put on your investments early on, especially if there's a down market, will only prolong how long those retirement funds are going to last.
Okay, good points, Tyler. Now what we're going to talk about here towards the end of the show is, what about your investments? Okay, people want to know, how should my investments change if we're going into recession, we think there's a recession, or we're in a recession? Well, first thing we're going to talk about is building up cash. Again, we've been in a 10-year market that has been a bull market. The market has been very good since 2007, 2008. There are certain times that the market was down, but it's been very short-lived. For instance, last year in 2018, in November, December, we saw probably the more volatility than we've seen in the last 10 years. So what we recommend is being able to pool cash, be able to sell certain positions at a gain in your portfolio and move that cash to the side in your portfolio. We're not saying take your money as cash. We're saying if you have a $100,000 IRA and it's all invested, you should take some gains off the table and turn that IRA into a $90,000 or an $80,000 invested portfolio and carry $10,000 or $20,000 in cash, so you can look to buy out of some of the market trough we might get into, or buy some investments that are on sale. Again, go back to Warren Buffett back in 2007, 2008. That's how he made his living back then, was buying when everybody was selling. Okay, he was happy when people were showing fear, and vice versa. So cash is king. What else, Tyler?
Yeah, so when it comes to preparing for recession within your investments and retirement funds, they're called large blue chip stocks. Typically don't get hit as hard as some of the other sectors and categories. So what I mean by that is usually companies that are large, U.S. based, they've been around for a number of years and they've withstood a number of market cycles. Those are ones that usually don't get hit as hard as, for example, small caps, mid caps, or international. So again, going back to 2008, there was different international small cap and mid cap funds that were down over 70%, whereas large caps weren't down as much. So one thing, by diversifying into the large blue chip companies, they usually aren't as volatile as small cap, mid cap, or international. So that's something too that you can do to try and minimize a little bit of your risk. Make sure that you're diversified. Another thing that I want to mention is it's hard to keep on investing and putting money away, especially when you see the market continuing to decline. But if you're younger, if you're in your 20s, 30s, 40s, even in your 50s and planning on working for a little while longer, if you can invest as much as you can during a time of market volatility or during a downturn in the market, that's only going to help you over the long run, because you're doing what everyone wants to do. But as Dean, as you had mentioned, not too many people can do it if you're fully invested, and that is buying low and then selling high. So especially if you're young, during a recession or any type of economic downturn that affects the market, if you can invest as much as you can and continue to invest over the long term, that's only going to help you. But there's kind of a mental block there for many people where when they see their account continuing to go down, it makes it harder. But if you can stick to that plan over the long term, you're really going to reap the rewards down the line.
Okay, good points, Tyler. We're going to hit a couple others here quickly, and that is if the recession is U.S. based, you might want to look at emerging markets. Not 100% of your portfolio by any stretch of the imagination, but you want to look at some emerging markets. So if the recession could be U.S. based, you want to look at that. Unfortunately, right now we're talking it could be global recessionary, and we've got a trade war or a trade tiff going on with China. So you don't necessarily want to go into emerging markets right now, but if it was U.S. based, you would. The other thing too is possibly change from growth to defensive investments or value investments in your portfolio. Now, too many people have looked at value investments over the last 10 years thinking that they were buying things at a low with a low PE, only to find out that they stayed low for the last, significant number of years. So you still have to have some momentum. But if you go into recessionary times, defensive stocks typically do pretty well. Some of the utilities, unless there's regulations that get hit due to a recession, some of the beverage companies, some of the consumer staples, do very well. The Procter & Gamble's and the Clorox and the Church & Dwight's do well. And also, again, if you get into some of the telecommunications that have been beat up pretty bad, showed some growth and then beat up again, those can give you a little bit of stability. Look at defensive positions to help, even out the peaks and valleys of your portfolio.
Yeah, good point, Sir Dean. Last thing I want to mention before we close up here is just that when it comes to preparing for a recession, right now might be the time to go and rethink your investments, try and get a little bit more defensive. But again, don't make a knee-jerk reaction and panic just because there's talk about a potential recession.
Good points, Tyler. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.